I would like to now welcome Brian Kearney to the meeting from Mercer Investment, and I'd like for him to present his report to the meeting. Morning, Brian.
Good morning. Thank you very much. I guess I haven't met some of you, so I might quickly just introduce myself and a brief overview of Mercer and how we work with the committee and the council. My name is Brian Kearney. I am based in Auckland with Mercer in New Zealand, and I look after investment consulting and investment solutions. So investment solutions are the side of our business where clients invest in the Mercer products as funds, but investment consulting is where we act, as we do with you, as an advisor. So predominantly providing strategy advice, first and foremost, to make sure that your long-term investment strategy meets the investment objectives and spending needs of the council, and then the implementation of that strategy through selecting managers and monitoring them on your behalf. So our quarterly reviews generally focus on the performance of the funds and our view on how markets are doing and how the funds are doing in those markets, and then keeping a close eye on the underlying managers, because that's where the majority of your risk sits, is in the selection of those managers. We've provided a quarterly report in the pack. I don't propose to go through every slide. I know that you read the material ahead of time, and I'm happy to take questions. I'll just briefly touch on markets, as I'm sure all of you are aware. Market conditions over last year were some of the most difficult for diversified funds. So funds with equities and bonds, which generally are your, a blend of equities and bonds, gives you a nice diversified product range to weather the long-term storms of investment markets. Well, last year was the most difficult time, essentially in most of our history, in terms of having a combination of equities and bonds be sort of hammered by interest rate movements and the outlook for global markets. So really was quite a trying time. There was a little bit of a reprieve towards the end of the year, but now we certainly hope that as we move forward and the markets start to accommodate the new interest rate world, that things return to a bit of normality. Looking at the third page of my report there, with the bar charts at the top, that gives a bit of an indication of how markets have operated. So the page headed Investment Environment NZ Quarterly Market Review. The light blue bars there are the annual returns to the end of December, and the dark blue bars are the quarterly returns, the 3 months to the end of December. Can I just check, can someone give me a page number reference if they found their page within your pack? Just
page 49.
Thank you, Janine. So, certainly quite significant downturns there. New Zealand equities on the left-hand side down 11%, slight recovery in the last quarter, up 3.8%. And global equities in the middle, so GE global equities unhedged down 16%. So that really drove a lot of the market returns and portfolio returns. The key driver there in terms of what actually drove the returns and linking that to the economy, it was all about inflation risks. So how the reserve banks around the world were trying to combat inflation by moving interest rates, and essentially the central banks increasing interest rates to try and stem spending and demand, and then hoping that brings inflation under control. Obviously, that was quite a challenge when inflation has been driven on the supply side more than the demand side. So when it's supply chain shocks and petrol prices around the world, it's very hard to bring that under control by making mortgages more expensive. But that's essentially the predominant tool that central banks have, so that's what they use. This year's story is all about how is that going to factor into economic productivity, and whether the very sharp increase in interest rates we saw last year is going to lead to a recessionary scenarios across the different major economies in the world. Our view at the moment is there certainly is likely to be some volatility in the future, but that we've probably borne the brunt of the pain of this interest rate increase and return to a bit of a more normal interest rate arrangement across the globe. So we're hoping that once we get through this volatility of markets needing to price in the risk of recession, we're actually hoping that things calm down and we don't see a significant risk of a major recession. There already are some technical recessions in the world, but in terms of a true impact on economic productivity, we think that there should be a soft landing, as the media has called it, which is the ability to bring inflation under control globally without a major impact on having an economic recession. I'll flip over to the manager and asset class performance, which is a few pages further on. It's page 4 in my section. I'm guessing it will be around page 53, 54 in yours.
Correct, page 53.
So the focus for us is really are the managers doing what they need to do throughout the market cycle. A quarterly a period of 1 quarter is always almost impossible to judge a manager on, so we tend to look at over the quarter if there's any significant outliers, and that would be an indication that those managers are potentially taking more risk than we expected. But for the most part, we look at the 3-year numbers and perhaps the 1-year number, depending on the context. At the top of the page there, you can see the fund returned a 1.9% positive over the quarter, and that's just slightly ahead of the benchmark. So the benchmark is the market return that we would expect to receive if it weren't for the managers outperforming the markets that they invest in. So basically keeping in line with the benchmark over that quarter, but as you can see, the 3-year and 5 years numbers being a bit more healthy, so 0.6% above benchmark over the 3-year period. And I won't go into every manager, but the short summary there is there's no significant outliers that are of concern to us at the moment. The real assets at the bottom of that page are something that we're keeping an eye on, and certainly expect that when we go through our annual manager review, we'll put a bit more of a spotlight on those assets and just ensure that they're really playing the role we expect them to play in the portfolio. But broadly speaking, the fund's sort of benefiting from most managers doing fairly well, and the strategy certainly playing its role as we go through these volatile times. I may pause there and see if there are any questions. I realise you're tight on time.
Thank you, Brian. It's Chris Hughes speaking. I'm chair of the Finance Committee. Just a question regarding on your page 4, manager and asset class gross of fees. The figure of 7.3% for the total fund since inception, and the inception date says April 1995. Now, am I correct in my assumption that that is the performance of the managers rather than the performance of the fund since that date?
Well, the performance of the managers rolls up to be the performance of the fund. So that the number we're looking at is the top right of that page. 7.3% is the annual return that your investments have made since inception. And then the number below it, 6.5, that's the benchmark. So that's essentially if you had implemented your strategy, but without the benefit of the managers you've selected and just received the market average return. For this strategy, you would receive 6.5%, but you've managed to outperform that by close to 1% through the selection of managers that you have in your portfolio.
Thank you. My second question is, the last 5 years have been 3.6%, which is a long way below that inception figure. And I'm really interested in knowing how the actual Waikato Regional Council Fund has performed, say, over the last 10 years. That's 6.1?
Yes.
Yep.
Yes,
Okay.
that's correct.
So there must have been some outperformance in the periods in the prior 5 years. Would that be a correct assumption?
Absolutely. So when we say outperformance, we generally mean versus the benchmark. So whether the managers and our strategy is performing well against the benchmark. But I think what you mean is that the first years of that 10-year period were higher returns than the most recent years, which you're absolutely accurate on. And the key driver there is interest rates. So if you look at the last 10-year period, the first 5 or 6 years of that was a period where central banks were bringing interest rates down. So essentially trying to improve economic productivity globally by bringing interest rates down. That had a significant benefit for bonds and equities. So essentially, it's a rising tide raises all boats. So investment markets did exceptionally well. Since about 18 months ago, that has been the first turning point in a decade where central banks have reversed that interest rate positioning, and that decreases the value of bonds, and it has decreased the value of equities. And our focus is we can't time those decisions and we can't stay out of markets when that happens because no one has the crystal ball. But what we can do is try and ensure that our managers still outperform the markets during those times. So once you've weathered a storm of a market downturn, that actually you've added to returns.
Thank you. Just a second question, if I may. You obviously had some input into the existing SIPO for the Regional Council. Given the current market situation, the fact that the council fund is in perpetuity, we don't have a finite date, it's a generational fund rather than a fixed date fund, obviously. Do you think the current SIPO is fit for purpose, or do you believe it should be reviewed?
That's a very good question, and I think the underlying question there is probably whether the strategy with a lower than average growth allocation, because you do have a fairly defensive portfolio versus some other long-term investors. So I note that is a reality, that you have a more defensive or less growthy portfolio. So when you have market recoveries, you may miss out on some of those returns. We reviewed that strategy in detail and at depth with the committee and talked about this growth versus defensive split. I personally feel that it probably is appropriate given the risk appetite of the council, and that if you look at this period, we can actually look back at this recent downturn and see how the more defensive nature of the portfolio has actually stood the council in very good stead. And that's exactly what informed that decision when we reviewed it. I believe it was about a year ago. But we are due for regular reviews. So this is a conversation that certainly will be facilitated for the next review.
Thank you, Brian. Does anybody else have any questions of Brian? Okay. Brian, thank you for your input and attendance at today's meeting. We have a resolution to pass now, so maybe we've all, you're happy to. It's been moved and seconded. Mike, do you know that? All in favour? Against? Carried. Thank you, Brian. We can let you get on with the day.
Thank you all. I'll see you soon. Bye.
Okay, thank you.
Sorry, Mr. Chair, just a question on that. Just discussion about regular reviews. Are those scheduled Is there a certain time horizon that would be happening in?
So through you, Mr. Chair, I need to catch up with Brian to work through the work program for the fund this year. I do just note though that the last Finance and Services Committee had passed a resolution around a review of our strategic advisor. So to do a formal market approach around evaluating Mercer against other similar entities as well. So we need to have that work completed by August, which is when Mercer's contract currently expires. Just talking to the chair before the meeting, I think then we need to consider if we're going into that space of who our strategic advisor is, who is it that you actually want leading you through that really strategic review of the fund and the fund objectives? Is it Mercer under the current arrangement, or is that something that we should be doing with potentially a new fund advisor, not precluding any outcome from that process?
Thank you.
Thank you, Councillor Story. Councillor Nebo, I believe you're on the Waikato River Authority. They have a substantial fund. Could you share with us, I know it's online to go and look at, but the experience with them and the way they go about managing that fund?
Yeah, no, look, off the top of my head, no, I couldn't, Chairman, yeah, but yeah.
Thank you.
I think one of the key comments that Brian made in that is around council's risk appetite. And so obviously we'd had some conversations around general risk appetite last week with KPMG, but I think that is part of the conversation in terms of looking at the overall investment strategy, is what is this council's risk appetite in this space? Obviously, you know, no return without some risk, but where's the view around this table now on that?
Yeah, and thank you, Director Janine, for that. I think that'd be a discussion which would be well worth having. But in the interim, what I've asked Janine to do is to maybe have a discussion with her peers within the regional councils and council groups, just to see what other people are doing and who are they using, so we can basically have a knowledge base from which we can then start to make some decisions going forward. From my experience, the performance since inception is 7%, which is about where it should be. Performance over the last 5 years is not where it should be. And I'd like to understand that a little bit better. I hear what Brian's saying regarding interest rates, and it's absolutely right, but most funds have been achieving around the 7% over the last 5 years, apart from the last 12 months, which is an outlier. So I think it is time that we put an item on the agenda for a future date for discussion and wait for Janine to come back to us with information. Thank you. Happy to share. All right, the next agenda item is Treasury Management and Reporting, and the report to be presented by Director Janine. Thank you.
Thank you, Mr. Chair. So this report largely is supplementary to the information that you've received already from Mercer, more around the internal administration of the Treasury function, and includes our working capital management as well as an overview in terms of the borrowing program. And so there are a couple of key points noted in the report in regard to those. So first of all, staff are seeking approval from the committee and to be referred to council for the breach of a counterparty risk policy. The counterparty risk policy effectively sets a cap at the level of funds that we should be investing with any one financial institution at $40 million. And that's really just I guess, a way of diversifying where those funds are held and managing that exposure. In December, our Treasury portfolio had landed in the position of having $48 million with being placed with ANZ. And so that's outside of that counterparty limit. So we do need to seek, and my apologies, retrospective approval from Council on that matter. We have noted, or I've noted in the report, staff undertake a process when we're placing funds on term deposit to get quotes from all of the banks that we deal with, and we will typically go obviously with the highest rate. And so I believe that's what's led us to the position of having too much money with ANZ. And so there is a small benefit in terms of the return. Noting that it is outside of policy though, I have asked the team to do just a compliance review in terms of all of our processes to make sure that we've got all of the belts and braces in place, so we're not in this position again. The other recommendation that's in front of Council for consideration is for Council to attain a formal credit rating in light of our future borrowing levels. We'd asked this question of PwC, who provide us advice in the Treasury space a couple of years ago, and at that point in time was sort of a bit break even. The recommendation now, based on forecast borrowing, is that that would give Council a benefit around a lower interest cost, so about 20 basis points, so 0.2% on our borrowing program, offset to some extent by the costs of complying with the attainment and retainment of a credit rating. So a net saving to Council in the order of an estimated $60,000 per annum. So the advice that's been received from PwC is provided there for the committee for their consideration and direction.
Thank you, Janine. Do you have any questions of Janine, please?
So,
Councillor Neba.
I'm not an expert in this field, but my reading of this was that it seemed a logical thing to do. And obviously your recommendations that we do that, Janine. I was actually interested in your views, Chris, as an outsider that's come in, as to whether you think we should be doing this or not. Because my reaction would be that I think we should, but in light of our forecast borrowing was that main reason. Yeah.
Yes, thank you, Councillor Kneebone. Look, I'm sitting on the fence. What the fee of 60,000? I think there's an upfront fee of 60,000 for certification, and then there's an ongoing fee of 60,000 a year. The cost that concerns me is the extra internal work that's generated by being required to comply with the credit rating, and I don't know whether that issue has actually been addressed at the moment. So purely analytically, yes, one would say you're going to get a payback out of it, but I'm not convinced that the added costs of compliance have been, well, they've not factored into that equation. Would it be worth it long term? That's going to depend on your borrowings. It's a nice to have. Certainly, credit rating gives the organisation greater credibility, obviously, within the financial community. But I am concerned about the cost. It's not just the $60,000. It does impose other disciplines on the organisation, discipline costs.
So that's useful. Could we have what are your views on those internal challenges?
Yeah, I guess I don't have a current view on that, but would echo the chair's comments, and so it is a cost benefit in terms of what we currently do and the extent of it, and what we will be required to do to maintain that credit rating. good discipline is always a good thing from my perspective. I guess the question in my head through this is with our borrowing forecasts and with if we looked at our historical forecasts of borrowing and where we actually land, which is always somewhere south of that, will we get to that sort of break-even point of $40 million borrowing at the end of this year or not? Obviously, the last few weeks have provided some more uncertainty in that space. So I think for me, this is probably really good future direction in terms of having that critical mass that warrants a credit rating. Maybe it's a not now, but reconsider it again in 12 months' time with more certainty of what that forward borrowing looks like. The last time we'd looked at it was when we were going in, I think, to the 2021 long-term plan and looking at those projections and going, does it make sense with all of that work that had been done around infrastructure strategy and things like that?
Through you, Chair.
Councillor Nebo?
Yes. I don't mind being true, by the way, here. This question is small meeting here. I'm assuming that forward projections in terms of what's happened in the last few weeks is just going to be an interim blip in terms of our borrowing. To me, the bigger question would be, are we always likely to be in a scenario where we're better having our investment fund separate from our borrowing? We're not likely to want to borrow internally as we did in the past going forward.
Yeah, and I think my thoughts on that would be that we are reaching a critical mass in terms of our external borrowing. So, you know, be it 40 or 100 million, 40 or 50 million even, against a fund at the moment of 90 million. That quite substantially shifts the way that you would manage that fund, and you lose all of that liquidity. We haven't got a diversified fund. When we had been borrowing internally before, we were sort of at the 10 million type level, and it was considered as part of our overall cash investments performing like cash. And so that makes sense, I think, where you start getting to the degree of the fund that we would have to put into a borrowing program. There's some fundamentals there that start shifting quite substantially that Council would need to consider carefully.
Okay.
If I could just comment there as well, it totally changes the risk profile of the fund if we're going to concentrate it internally, and that would need a change in the SIPO, which would be for Council. It's a good suggestion. And the second point I'd like to make is that we hope interest rates are going to return to a lower level over the next 2 or 3 years, maybe. One would expect that the fund will outperform the cost of capital. One would hope it's going to outperform the cost of capital. If it doesn't, then we'd have to ask serious questions about why. So, Councillor Strange, question?
Yeah. Thank you. Yeah. So our borrowing is set to increase quite substantially over the next. Okay. What is? Excuse my ignorance, but what is the generational impact of that borrowing? Like, do we just keep borrowing, or at what point does it get paid back? Or just indulge me, please.
Yeah, absolutely no indulgement needed at all. So predominantly our borrowing is associated with our infrastructure capital works. And so those assets generally have very long lives, and what we do is depreciate them. Because our depreciation expense, especially at the moment, is sitting substantially lower than our capital spend, because we've got an enhanced program with shovel ready, we've got effectively a cash shortfall which we top up through borrowing. In order to make sure that that's not penalising current generations, though, is what we do is we fund the depreciation, which will be over 50, 80, 100 years, and we use that to fund the borrowing program. So the funding impact is matched with the life of the assets rather than with the term of the borrowing that we undertake. So borrowing sort of sits in the background as a cash flow mechanism largely, and we fund the depreciation and use that to effectively meet those debt repayments.
Councillor Story.
Wondering if there's any way to translate what you just said into like a diagram or a
Yeah.
picture or something. I find finance, not being an accountant, I find finance extremely confusing. And I know you're all across this, but we're all sitting here trying to get up to speed. Particularly those of us, so I didn't sit on this committee last training. So any sort of useful diagrams or help plans so that we see how it all knits together. I suppose my question was around that. So the decision here is whether or not we go for a credit rating. If we go for a credit rating, there's the opportunity to save on interest, right? But if we get that credit rating, then that ties us into this the word you used, like accountabilities or
compliance.
ongoing
Compliance.
discipline. That was the word, discipline. So I suppose that naturally I would think discipline is something we should have as a an entity using public money and things like that. So can you give me a sense for what are those additional disciplines that this would then trigger, and which of those do we think may or may not be beneficial to us?
Those are probably answers that I don't actually have at the moment in terms of understanding what is required over and above the processes that we have currently to maintain a credit rating.
Look,
Chair, whether you have more insight into what that.
only anecdotally, the first point of reference is to the PwC report. They highlight that as an issue in there. And I can comment on organisations that I've had exposure to previously, and it does create some extra work internally to compliance, both in terms of the audit for the process of the accreditation up front, and then ongoing annually after that. So, look, I can't put a tangible number on it, and I doubt anybody could at the moment, without actually looking at the Standard & Poor's or Fitch rating document, and that then sets out the parameters which the organisation is required to comply with. So until one does that process, then it's very difficult to measure.
Okay, and it costs about 60,000 for the initial
Initial rating, yes.
and we think if we have this rating, we could save about 60,000 per annum in interest. Did I hear that, or did I miss that?
20 basis points.
Yeah, so the estimate
20
is a
basis.
$60,000 cost with a $120,000 saving in interest cost
Per annum?
per annum.
Depends on the borrowing level of borrowings.
Yeah, there's a break-even point in terms of where you're doing a dollar swap,
Right.
effectively between the cost of the credit rating and what you save on the interest, and that's at about 40 million.
Okay, but the ongoing extra compliance would be, we expect less than 60,000 a year.
Yeah, it will be a component of staff time. In terms of within the Treasury function of and there are those points noted there in terms of potentially sensitive information. I guess if there's a significant change in council's position, anything like that would impact rating.
Okay, I guess my initial non-finance type of person assessment would be if we can save 120 per year. And yeah, it's 60, and yeah, there's going to be some ongoing costs, but I thought that on balance, we're still ahead.
Councillor Story is quite correct. There is a on balance, but I think the drawdown figure is 40 million borrowings before you get to break even. We're not there yet, so we can defer it for another 12, this decision for another 12
okay.
months until we get to the borrowing level,
Level.
which is critical, which will trigger the benefit. Because we wouldn't get the
Okay.
benefit at the
Yeah.
moment.
I think the key point in terms of the timing of this is that over the remainder of this financial year, there's borrowings that are being signalled as required against the works program. It's either we borrow that short term to be able to refinance with a credit rating and
Right.
lock in that saving, or we accept that we carry on with that borrowing at the moment at a slightly higher cost. And when we get to that critical mass, maybe in 12 months' time, that the matter's reconsidered.
Okay.
And I'd be perfectly comfortable
With that further explanation, then I would support that.
Sorry, I recognise we've got two others standing in the queue. Can I just want to
Fine.
circle back to a question that Angela asked previously, because it's relevant in terms of the borrowings. I understand that the payments for our software as a service has been, funds being borrowed to make that those payments. I'd like to understand the methodology we're using to repay that portion of the borrowing.
Did you want that feedback?
If you can do it at another time, but I'm just trying to fill in a gap in the question.
Yeah, certainly. So in terms of those costs, we are expensing them as is required, but underneath that we do have a loan that operates against those costs. Council had agreed through the 2020-21 annual plan that the loan period for that repayment would be 15 years. So effectively that just gives us the mechanism to smooth the costs of that investment over a deemed life of the system, which hopefully will be more than 15 years. So we start putting in some repayment at the end based on what we've spent for the year prior to that project, sort of ramp up to payment. But it works just as a 15-year life.
Thanks, Janine. Councillor Nebo.
Oh, I can't remember whether I don't recall seeing any comment in here on whether other councils have sort of formal credit rating, because there's lots of other TAs that must have significant borrowing. Yeah.
Yeah, and I think one of the points in here is obviously within our debt capacity, that with a credit rating that goes up to, I think, 280% of our revenue, that's a level of capacity that we don't require. But certainly for high growth cities, without a credit rating, their capacity is reduced significantly from that. So they do actually need that credit rating because of the level of borrowing that they have in place.
So where I was going, because I'm just conscious at that point you made, Chris, about the internal cost of the organisation of going through this process, and whether, and I don't know whether councils with their uniqueness compared to other private enterprise, in terms of getting a bit of a steer on that sort of internal cost of those annual audit processes. Yeah. So look, as a non-finance person, I find some of the stuff that audit people put us through questionable at times.
Yes, certainly. I guess if the mood of the committee is to park this decision for now and come back to it, we can, through probably the local government funding agency with the list of their participating councils, look at the status of each of those. So which ones are credit rated, which ones are shareholders, which ones are guarantors, which ones are none of that, which gives a sense of where the sector at large actually sits in terms of these levers.
Thank you, Stuart. Angela.
Thank you, Chair. Yeah, I would, like that sector analysis to make a decision. Just a few questions around Treasury risk management policy. Is that our own thing? Is this the Treasury risk management policy? In paragraph 25.
Yes, so Treasury risk management policy is a WRC specific policy that gets oversight through Risk and Assurance Committee. So yes, it's the operating manual for all of the Treasury functions, both side. What Council adopts publicly is the financial strategy, which sets some of those high-level parameters, and that goes into the LPA. So you're locked into that. Then the way that we run the Treasury function internally and what do's and don'ts set out within that Treasury risk management policy.
Okay, and do staff have a level of comfort moving forward that 40 million one bank is the right approach? Do you see that needs to?
I think that is probably something that again we need to do a review on the policy and check in terms of time value of money, the size of the organisation's spend, what that $40 million looks like relative, to when it was set 3 years ago. So does that remain relevant today with all other parameters that have shifted quite substantially over that time? It's a lot of money.
And last question, if I may. I sort of understand paragraph 38 about interest rate swaps, but is that talking about the risk over this 4-month period of being in breach? So my question would be, what are the risks over that 4-month period of being in breach of our own policy?
So in terms of being in around our borrowing program, we would only be in breach of it if the council made the recommendation to seek a credit rating at this point in time, in which case we would do short-term borrowing to cover that period, and that borrowing is estimated to be outside of where we should have our debt maturity sitting, which is why it was sort of seeking preemptive approval of that, contingent on the decision around a credit rating. If the decision is to park the credit rating, then we will continue with the borrowing as we currently understand it and in line with that maturity profile. So we would be compliant.
Okay, so as a result, the number 2 and 3 resolutions are going to change, or just number 2?
So number two would change, which might be that and it wouldn't be a recommendation to council at this point in time. I think it would be that the committee reconsiders the attainment of a full credit rating at a point in time, and we can work out what that point in time is so that we can capture that as an action. Bullet point 3, in terms of the breach of policy, is the other side in terms of our working capital funds management that we have placed 48 million versus the 40 million with ANZ.
Okay.
So yeah, investing and borrowing. Yes, please.
Thank you, councillors, for your questions. I'm sure they're much appreciated, and it certainly helps others understand what's going on. And I'd just like to make a comment that the exposure to Australian-owned bank is very, very low in terms of the risk profile, so I don't see it as a big deal, but it is outside council policy and it needs to be regularised. So, all right, thank you very much. I'd like to move now to the resolution 1, which is the report of Treasury Management Monitoring Report to 31 December, Finance and Service Committee, 21 February 23 be received. That Resolution 2 changed to read that the attainment of a formal credit rating be deferred or pending the period when payback or the break-even point is reached with council borrowings.
I think we need to be a bit, yeah.
12 months, fine. Change that to be reviewed in 12 months.
Yeah,
And can we
maybe
also-
by December 2023, so end of this year. And if we're reaching more of a tipping point before that, we can always bring it back to the committee earlier.
I was just wondering, can we also though capture, like, for instance, the sector analysis that as part of that coming back to this committee, that we want to make sure we have that sector analysis. Then there were a couple of other things.
Yeah, so I'll capture those in terms of matters arising from the meeting. And so we can then formally report that back into your next meeting.
So can I just ask, would people like a resolution which puts a 12-month time set on resolution number 2?
Yeah.
Correct, yeah, for the review to be brought back to this committee. Thank you.
But I would say within 12 months, because that if we get to a trigger point earlier than 12 months,
yep,
we should act.
Correct.
Yep.
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 Which will be on Janine's radar.
But one question, should we already start practicing that within finance already though? That's the only question I have. Like Janine said she already has to implement some practices for that to go ahead. So if you're saying that within 12 months we may need to use it, why aren't we implementing? We're not going to go and get the consultant in, but why aren't we implementing those practices within our business so we're ready to go? That's the question I'd have. Does that make sense?
So through you, Mr. Chair, I think that the action is for staff to do some further work in understanding what the compliance requirements are, and absolutely to look at what needs to happen, because I think we need to do that to understand what the full cost of the credit achieving the credit rating will be, because that's material to council's decision later. So yeah, we'll capture that as an action.
Just through you, Chair, that wording, William, I think you need to go that the committee recommends to council the decision to review the decision to consider the attainment of a formal credit rating be reviewed within. Decision to consider the attainment of a formal.
While you're working out the resolution, sorry, Mr. Chair, I'll just have my 2 cents worth. I'm actually for a credit rating.
Decision.
Having passed, had that with Taupo District Council, borrowing, because we had to borrow quite a bit for the water quality system. And I think the benefits kind of outweigh even the internal cost of ratepayers. Believe the higher, well, we found with the survey, ratepayers believe with a higher credit rating that the institution is more financially, astute. People look at that to find that councils are using their ratepayers' money to the best that they can, re-borrowing or reinvesting. So, yeah, I'm all for it. And just clarifications, that 60,000 for the credit rating over 3 years or per year? You have to do it every year. Per annum. Yeah.
Just to be clear, the $60,000 upfront fee and then a $60,000 per annum ongoing cost. So we have an amended clause 2. And resolution 3 is that the committee recommends to Councillor Richard approval of a 4-month breach of the funding maturity profile policy limits and the Treasury risk management policy while a credit rating is obtained. Thank you, Steve. And Councillor Strange. In favour? Against? Carried. Right. Now, thank you, Councillor Story. We now move on to, once again, our lucky Director of Administration and Finances, rates information to December 31 December 22.
Thank you, Mr. Chair. A little bit of a change in tack in the topics for the committee, but this is a report that we provide to you every meeting to give you a glance at how we're going with the collection of our rates revenue, which is obviously very important source of funding for this council. Overall, our collection is in line with what was achieved to the 31st of December last year in terms of the current year rates outstanding. So 85% of total rates cleared by at the 31st of December, and then noting if we take into account future payment arrangements, remissions and other adjustments, that the net amount of the current year rates outstanding is just 4.76% of the total rates assessed. So that is actually in a better position than the previous year. As I think Director Williams had noted in his presentation earlier around Te Ara Tupu, the rates team that sit within the Finance and Business Services Directorate actually take a large volume of customer contact through the team, particularly in the lead up to the due date at the end of October, but then following the first penalty round that we do in November. And so you see there that, you know, about 13,500 phone calls and 19,000 emails over that October, November, December period. So they really are for a number of our ratepayers the window into the organisation, and do a great job at that. Through those interactions, some of the things that they administer is things like direct debit authorisations and setting up customers to receive their rates bills via email. And so we've seen a continuing positive trend in terms of those easy to administer both payment and communication methods. Overall, direct debit is Council's preferred method of payment. It provides ease of payment for both payment management for both customer and council. Auto adjustments are made to payments every year. You know, it's just a low friction way of transacting, but obviously doesn't work for everybody. In terms of just some of the trends, so we show that information in terms of comparatives to previous years around rates arrears or outstandings, noting that in large those trends in collection, if we're looking on a percentage basis under paragraph 11, are really in line with or slightly better than had been achieved last year. In terms of addressing some of the rigidity of the rating system, Council also has rates remission policies which enable you to take into account those matters that actually aren't accounted for within the property rating system, such as particularly you know, conservation, covenanting of land and things like that, that align with Council's purpose and the outcomes that we're seeking to achieve. So under paragraph 13 in the report, we provide a breakdown of the remissions that have been granted this year and compared to the value of remissions granted in the previous year as well. Noting there, I guess, in terms of the hardship remission, which again is a conversation that we had through the annual plan around the level of uptake that we're seeing on that remission versus the provision that council has made for it. Really good progress made this year, but still some opportunity to do some further work to ensure that that support is getting through to where it's needed in our community. In terms of rates arrears collection activity.
Sorry, Mr. Chair, sorry, Janine, just into that. Yeah, I'd really like that to progress. That was a real hard one for the decision on the annual plan to not vote for it. To me, because there's a big group of ratepayers out there that don't know how to access that, and they're the ones that need the help.
Thank you, Councillor Downard.
So we just note in terms of rates arrear collection activity, and where we are writing debt off. Changes in legislation in 2022 gave delegation to the Chief Executive to write off amounts that are deemed that they can't reasonably be recovered. And so we disclose those here to the committee, as well as there's the requirement to include those in the annual. Every opportunity to follow up on those is made before it gets to the point where if we haven't been able to achieve any sort of collection activity, they do become statute barred, and our hands become tied in terms of that passage of time. But with that general overview, happy to take any questions.
Thank you, Janine. Only question I have is in relation to statute barred debt. Do we have a bring up system now which highlights any debts which are within 2 years of statute barred, so that we can actually start the collection process before it becomes too late?
Through you, Mr. Chair, yes, we do. The team work really hard in terms of that collection activity. We do have challenges with some of the property information of actually, which we rely on territorial authorities to provide us that data, of making sure that we can actually be contacting those ratepayers. But obviously write-off is sort of one of the last resorts in terms of that. And, you know, if in future years we can actually recover these costs, then we would certainly attempt to do that.
Thank you, Janine. If there's no further questions, I'd like to move the resolution of the report 22-23 rates information to 31 December finance. So thank you, Stu. Jumping the gun. All in favour? Against? Carried. You're right. Okay, we go on to the next agenda item. Councillor, Chief Executive Director expenses for the quarter ended 31 December. Once again, Janine, you're in the chair.
Yes, Chair. So this report is provided for information and full transparency in terms of expenses across elected members, the Chief Executive and directors as well. So hopefully elected members should have received the details of their own expenses prior to the meeting, so it should be a no surprises from that perspective. But this is really just, I guess, so that peer to peer you can see what's happening and hold each other to account where that may be required. But in terms of the executive, you know, acknowledging that these are sensitive, this is sensitive expenditure, and that there needs to be you know, high levels of prudence and diligence in terms of incurring these costs. So we provide this transparency again in terms of both the Chief Executive and Director's expenses.
Thank you, Janine. Stu, you have a question?
Yeah, just quickly, I'm assuming because the Coromandel and yourself, Mike, usually broadly similar, is one of you guys staying over and one's not? Is that what's causing the big discrepancy there? Okay, no. Yeah. You know, that's all good. I'm just making sure there's a rationale for the difference, because they're generally broadly the same, and obviously accommodation cost as well. So it's 6 to 1, half a dozen to the other. But yeah.
Thank you. Any further questions? If not, I'll put the resolution to the meeting. Moved Kneebone, Story second. All in favour? Against? Carried. Thank you. Now, the next agenda item, if people would like a break, you're welcome. If like the meeting adjourned, or you have to carry on? Okay, thank you. We'll carry on. Tenders board contracts from 1 July to 31 December 2022.
Thank you, Mr. Chair. So again, this is a report that's provided for transparency for the committee. I guess an overview of the procurement process and the role of the tenders board is provided there for you. In essence, where council is entering into a contract that exceeds the individual delegation of a director, that is which is 250,000. That's required to go through what we call tenders board, which is Chris and his direct reports, requiring either himself or myself to be involved in all of those meetings. Where expenditure is council multi-year and council's funds of more than $2 million being expended, they actually come through this committee, and so we've got a couple of those reports coming later today. So these are all of the matters that the tenders board has considered since the 1st of July 2022, noting that some of these were also referred on to Contracts Committee at the time, or now will come through the Finance and Services Committee. So happy to take any questions on any of these items.
Any questions for Janine? If not, I would like to move that the report tenders board contracts for 6 months, July to December, be received. Do I have a mover? Who moved that? Oh, sorry. Councillor Downard, seconded by Story. In favour? Downard, Councillor Downard and Councillor Story. All those in favour? Aye, against, carried. Oh, so thank you. We will now move into exclusion of public from the meeting. It's been moved by Councillor Nebo and seconded by Councillor Strange.
Yeah, I just need to quickly. The reason we're moving into public excluded is to protect information whether making available at the information would disclose a trade secret would be likely to prejudice the commercial position of the person who supplied or who is the subject of the information. All this is under section 7(2)(bi) and II of the Local Government Act. Another reason is to avoid prejudice to the maintenance of the law, including the prevention, investigation, and detection of offences and the right to a fair trial. All this is under section 6A of the Act. And to protect the privacy of natural persons, including of the deceased natural persons, and this is under section 7(2)(a) of the Local Government Act. And yes, I do believe that. Yeah, I just need 1 minute to